If you press that red button in the Chernobyl power station, this baby's gonna blow. You're gonna blow the whole damn thing up. And I've been like, Jay, please, no, guys, don't do this. Ladies and gentlemen, the circus is back in town, and this week, I'm delighted to say, I've got a new friend, Josh Answers, and the Trading Fraternity. Big shout out to the trade frat boys. Of course, this is the Acid Capitalist show. We're going to put it out on both platforms. Josh has some good meaty questions. I hope you enjoy. I'm out there, of course, Hugh Hendry official. You'll find me in my swimsuit. You'll find me like walking through the trails in Malibu where I am presently. I think the next port of call might see me in the mountains of Utah. Time will tell. But Hugh Hendry official, Hendry_Hugh on Twitter. I'm beginning to get some time, and I'm getting a looser, and I'm trying to share more of my observations, especially about this kind of de-dollarization nonsense. But the thing I really respect and the joy of the weekend is reading all of these wonderful comments that you guys and ladies kindly leave. And we were thinking of shaking it up. Like, I'm going to try and find the best comment, and I'll share that, and then I'll perhaps we might reach out and ask if the person with the best comment would like on a Zoom call to pose that question to me. We'll film it. We'll film my answer to it, and then we'll put it back at you. So come on, people, let's be creative. Let's write. Tell me about hats. I mean, design me a hat. Let's make it happen. I mean, how do we get that? I mean, I recommend you panic, but this space is small. Is it IRUP? I don't know. But anyway, I'm into more and more engagement. If you're enjoying the show, please rate it. Just, it's kind of like Trump, hate me, love me. Just don't ignore me. Anyway, enjoy the show.
All right, ladies and gentlemen, I hope you are having a wonderful day. We have a very special interview today. We are here with Hugh Hendry, the acid capitalist. You have seen him on Bloomberg. You've watched him live on stream, and you guys even sent me some questions for him. However, we're going to get into a lot of different stuff here. Man, look at the guns too, baby. But it's going to be an exciting one. It's a real blessing. So make sure you guys even show Hugh a lot of love after this. But I mean, there's a lot of places where we could start with this. So I don't know, Hugh. I kind of want to keep it a little bit light to start. I have a lot of questions about the yen. And I was even telling you before, if you guys didn't see that Bloomberg interview in September, Hugh actually called out the whole collateral thing. But I'm going to start with a more fun question. Somebody sent me this one, Hugh, and I thought it was very interesting. So they said that in a previous interview, you were talking about having your best creative ideas by not sitting at a terminal for 12 hours a day, but by being idle. So what can you offer advice for this area for anybody doing anything trading, investing wise? I think we'll start there, and then we're going to get into the yen.
Yeah, great. Well, first of all, Josh, wonderful. Wonderful to share the time and space with you. The question's good. I did my utmost not to be the suit and not to conform. I'm kind of on a mission that we live in this awful space where finance is just dull. It's just black energy. And it doesn't have to be that. This perceived orthodoxy is simply that. It's a perception. It doesn't have to be your reality. We're talking about time travel. We're talking about having the audacity to see the future. And so I try and play games, and I try and create neuroplasticity from getting distance, from doing other things. I mean, we're constantly processing information. I mean, one of the things for me, I can't read. I mean, I can read sometimes, but the format of a physical book no longer works for me because I need the Kindle. And why? When I'm reading, there are phrases, there are sentences, and they will elicit a response in my mind. I've got so much traffic passing through, and I'm trying to work it out constantly in St. Bart's, surfing, doing yoga, whatever. And there's something about just a well-phrased sentence or some conjecture, and boom, it just all comes together. And so I need to be able to capture that, screen grab it. Here I am advertising Kindle, but the grabbing it and bringing it in, and that really works for me. I think that comment, the question, stems from, I can remember stacking hay in a barn in the English countryside. And I began to see the evolution of a currency trade. I think maybe long the South African rand. This is going back like 12 years ago. So
I was going to say, when was this? Like, when did you realize this? When did this desire to, like, I guess, get outside of the traditional way? Because everyone think, I wake up early, but I don't really do things the normal way. But a lot of people think you gotta, books, read. If you're not getting all this information, if you don't know the charts, you'll never make money. Like was this 12 years ago you realized this?
So the first thing, it is a passion. So I was a grown-up adult. If we go back a long time, 30 years ago, and I was reading the Jack Schwager interviews, with market traders and stuff, literally under the duvet with a torch, like it was a boy's own adventure. And I've interviewed and hired a ton of young kids, and you got to have that prerequisite passion. It's got to be oozing out of you. Passion is the thing that makes it happen. And so, I read it all, but that was formative, and then it's stored, and then we have to do other things. I was fortunate. I met a kind of a cranky kind of genius guy in London, and he said to me, "Hey, look, the challenge here is playfulness, is curiosity." And for me, again, music. I was going to say pop music. I'm not really pop music, but music. So I spent a lot of time at home. I wasn't good in offices because I had loud music on. I got to move. And then I created, with the Bloomberg, you can download an index. And then I had my chart configuration, and I could load in 400 or 500 stocks, and I'd get like 30-second blasts. I called it chart pornography. And I was just looking for, my mind's, like pornography. What is that great judgment? It's hard to define, but my God, we know it when we see it. And so I had all of this moving wallpaper, and then the backdrop would be Pink Floyd or whatever, and ideas would come, and with those ideas, I would then come back into a conventional world. I had an intelligence operation. I had really, really smart kids working with me. And I'd say, listen, I don't know, I'm crazy, but I kind of want to do this. Why? I think this is why I want to do it. I could always conceive of a macro narrative that would kind of explain what I was doing. But I was like, you go out, test, and come back. Push me back. So through all of that, we created a synthesis, and we created an eclectic portfolio.
Interesting. So it was knowledge obtained and living life helped bring it out, essentially. So it's kind of a mix of both. Yeah,
but a rich life. And I'm trying to show that, on my Instagram stream and everything else, these short stories. I am constantly moving. I'm kind of, for the last 6 weeks, I've been traveling back and forward from West Hollywood, Venice Beach, London, Paris, Scotland, and there are things happening. I'm seeing people, but at the same time, all of this traffic is coming through and it's being processed, and I'm getting a better understanding of things.
Yeah, and you have a deep understanding. That's the thing, though. I think so it seems like you live in life, you're enjoying it, and that's helping you bring it out. But now to your understanding, like, I feel like you have a grasp of the markets and a lot of things going on way better than most. Even then, I guess part of your claim to fame is your performance during 2008, correct? Didn't you have, like, people were getting mad at you because you did so good and you were just on top of it, and even relates to some of the stuff we got going on now, but it's like a deep understanding. You do hold those still, right?
Yeah, people they don't like it when unorthodox approaches come to the fore and make a mockery the others. You know, I can recall back with if we go back almost 25 years, you know, the NASDAQ bubble, like with the chart formation, you know, like keeping it simple and again, without, you know, people have all these isms, you know, socialism, etc., and they become tribal. Trying to be loose, you know, I bought things going up without prejudice. I sold things going down without prejudice. And at that great time, things were going up. And people had prejudice and they were shorting or they were avoiding it and they were being killed. You saw that with Tesla. I mean, the number of people who got killed with the almighty rise and rise of Tesla, smart folk, people who actually saw that phenomenon 25 years ago, but they still had this urge to fight it. You know, for me, I'm simple. I'll buy things going up and I'll sell things going down, or I'll do nothing. You know, those are my states of being.
So how would you apply that to now, though? So now let's take it to even now this market. How would you feel about things going on now, buying and selling without prejudice? How do you think people are nowadays, even yourself?
So I mean, right now, I mean, my message all of this year is to, you know, there's a provocative beginning. You know, this market's easy. That's provocative. Yeah, no, markets are never easy, but you know, this market's easy. You avoid stocks. And you own the ultra long end of the treasury market through like an ETF such as the TLT, the tilts. You got to tilt into this market. That's been my message. Now that if there are wise, seasoned listeners and watchers, they'll be going, hold on just a second. What? WTF? Because I'm actually contradicting myself because the tilts have been trending and they've been trending down. So what happened to my kind of simple, loose approach? So like everything, you graft on elements to it. Experience. And there's a wonder and a joy of something that happens in the financial universe, which is mean reversion. Now, mean reversion, when it occurs to individual kind of stock positions and the like, is really, really not so appealing because there's so much idiosyncratic kind of stuff that comes along with that. What I'm talking about is mean reversion in a macro universe where there's like, you know, if there's 4 cardinal points in a compass or whatever, there's the gold price, there's the treasury bond price, there's the dollar price, and there's the S&P. You know, there's my compass, okay? And when I see mean reversion in those 4 compass points, I get intrigued. I think we live in a macro world where mean reversion in those huge macro assets becomes a profit opportunity to lean into. So I think the TLT, or the ultra long treasuries, it's mean reverted. Yeah. I mean, in terms of, if we ignore the income, which is a considerable kind of, let's just ignore something considerable. But if we just look at the price component of treasuries, we've wiped out over 20 years of price performance. Yeah. And again, simple, I like 20 and 4, what am I saying? Like really long moving averages. Would I use what are these? 200
day moving average?
No, 200 months.
200 months.
200
oh,
months.
You know, I actually saw that recently. I think even the Hong Kong index was hitting like the 300 month moving average or something like that recently.
Yeah. And that's where we are with the treasuries. You've wiped out 20 years of gains. From a macro perspective, I know 2 things. I know that the economy is just not working. It's kind of illusionary. Yeah, we add on GDP, but it's at the expense of mounting levels of debt. For the ordinary people, per capita GDP just is growing at its slowest and most disappointing level, I want to say kind of ever since we invented like modern economics, ever in the period of, let's say, 150 years. And then I know that we have this form of regulating the behavior of trading continents, the US, China, Europe, Latin America. And it's being gamed by a group of countries called mercantilists who are pursuing a beggar thy neighbor. It's a cruel spectator sport. It's awful to see. You know, on the one hand, I'm saying to you, ordinary folk are just not participating in other people's prosperity. And I'm laying the responsibility at this really strange thing. What is a strange thing in economics? We have countries which year after year after year are generating surplus trade balances, predominantly with America. And I've got to tell you, economics was never conceived to operate in that manner. Economics was conceived in terms of creating a disequilibrium which would generate the forces which would pull you back. And those forces are being held in abeyance by policies such as the undervaluation of the Chinese renminbi, but essentially by the impoverishment of the household sector in places like Germany, China, Japan, et al. And in doing so, they're transferring a lot of what should be the wealth of the household sector, and it's coming into capital flows, which is essentially the purchase of treasuries. And they're bringing all this capital. All of the world's free capital is being dumped predominantly in the US and secondary in the UK. Why? Because they're open and liberal economies. No one protests about you putting the money in, and you can pull it out. And so we've got another strange phenomenon, which is in the US, it doesn't need the capital. It doesn't need it to fund investment. Domestic investment needs, or the demand for, are actually historically, they're kind of muted and low, and they're absolutely accommodated for by domestic savings. And yet all of the rest of the world's savings are coming into the US and being dumped. Now, when that happens, we're dropping kind of Mount Everest into this lake. Yeah. And it's creating this tsunami of liquidity, which is creating inflation.
The hot money.
Yeah. And it's making, all the guys who handle equities rich and rich, but it's creating
the equity panhandlers.
Yeah.
I'll even ask you this. I think it's a great segue because you're talking about everything with the world, all these countries, again, just like the imbalance with all these different countries. How do you feel about this thing going on? Because everybody keeps asking me this. I have this debate on the daily now. What do you think about the de-dollarization and the BRICS? Is that a threat? How does that even play into what you just said about the other impoverished nations and even dumping the surplus into all of our financial assets? What do you think about it?
It is complete and utter bullshit. It reflects a profound ignorance on the nature of economics and money. One of my slogans is there's only 5 people who understand.
Yes, we want to know who. We want to know who. Hugh, we want to know who those. Give us one person. We know one of them. I think it might be you because you said they surf, they got long hair, and they don't wear suits. So I don't know. Can we get a name? I know you took an oath of secrecy, but
indeed, I certainly am acutely aware of their work, and it's very much the forefront of how I think and operate. But I would have to defer. But let me tell you, there are 2 people that I hold in profound esteem. There is a professor of economics at Peking University, Michael Pettis.
Michael Pettis.
He's collaborated with Matthew Klein, and they put out a book called Trade Wars. I think Trade Wars are Class Wars. And I think of Michael as being a modern day Keynes. And before some of you start going, oh, Keynes and Keynesianism, be quiet. You're just swallowing propaganda, and prejudice is no place on this platform where we're trying to execute best ideas. Okay.
Amen.
So Michael is a great source and inspiration for me. And then, sometimes I feel like I'm just John the Baptist with Jeff Snyder over at the Eurodollar University. You mentioned collateral. Jeff is the collateral king, and the work that he has pursued with his kind of university program on YouTube. It's tough. It's a real deep dive into an arcane world. And I'm trying to facilitate and share my understanding. So I take Jeff's kind of thinking of money, and I process it through me, and then I send it towards to you guys.
Interesting.
So this question about the de-dollarization, right? I mean, it's nonsense, right? Why is it nonsense? It's nonsense because I said to you that we have these persistent trade surpluses. China operates on the basis that its GDP can only expand as it pursues more and more share of the world's industrial activity. And so it's kind of insisting on a high savings model so that it can build more and more infrastructure. And the infrastructure is really kind of like creating a moat, a protective deflector around these huge metropolises of international trade, these excellent centers. The productivity of the Chinese is it's all right. It's really it's the stacking of this insanely dope, amazing infrastructure, and that it's so plugged in that it works. But that model, the cash, the flow of funds that comes to China, so ordinarily that should enrich Chinese citizens. They should feel wealthier vis-a-vis the rest of the world. How that happens is that the Chinese renminbi or the yuan would be stronger. You know, if you think of Europe in the 1970s, the currencies were like space rockets versus the US dollar. Like Germans became really, really rich vis-a-vis the rest of the world. You know, they could buy American manufactured products, and it was less and less when they paid for it in Deutschmarks. And so they would buy more. And as they bought more, they would be creating American jobs. That whole process should be happening in China, but it's not, because they take the dollars coming in and they push it straight back to America and they buy treasuries. So the de-dollarization could only happen if countries such as China were willing to allow their currencies to appreciate. The Chinese currency today, I want to say, is about 690. You require 6.9 yuan to buy $1 US.
And then they freak out if it goes above 7.
Yeah, let me tell you that 30 years ago, 1994, when we had the initial NAFTA economic agreement between Canada, the US, and Mexico, the Chinese devalued, and it settled around 8.5. So that's like almost 30 years ago, 8.5, and today it's 6.9, which is to say it did require 8.5 yuan to buy $1. Today it's 6.9. So the yuan has increased in value. Those Chinese citizens are modestly richer. But I want to say to you that in economics, it should be trading at 4, that those Chinese citizens should be dope-tastically much richer, and therefore their demand for exports from the US should be huge. And that's how we would escape this conundrum of the world has too much savings and not enough demand, and therefore everyone ends up stacking boxes at Amazon. So China would have to give up on its trade policy. The dollar is paramount to the success of the Chinese, and unfortunately the success of the Chinese, and indeed the other mercantilist nations, is at the expense of the US household sector. There's only two groups who participate and profit from this environment, and that is the kind of autocrats who run the Chinese system. They're in office forever, and it's Wall Street. Anyone who is close to the money gets richer, but as they get richer, they spend less and less of their income, and everyone else is left with maxing out their credit card. So de-dollarization actually would be a wonderful thing. Every, you could say 70 years or so, you kind of get cracks, the gaming and the cheating becomes so obscene that the whole system blows. That's what happened at the end of the 1920s. And something impossible happened. And that's, again, get distance, get creative so that you can have a sense and you can have the courage to conceive of the impossible. The impossible back then was the British government rejected the gold standard. They came off the gold standard. I mean, it was impossible. Like, no one could conceive of that. Yeah. And yet it happened. And so I think if there's going to be a de-dollarization, it's not going to be because China and Saudi Arabia are like exchanging oil for renminbi. It's not going to be because Lulu and Lululand in Brazil is trying to encourage more yuan to circulate in Brazil. No, it's going to be because Americans give it the finger and they say, no, this thing's over. We're not going to tolerate it.
And that's what I said. I told everybody who's told me this, I was like, listen, I'll believe it once you stop taking dollars for anything. If the minute you let me pay you in a ruble or a yuan, I got you on that. Great. I love that, though. I love that thinking.
Stick it to the man, okay? Because it's not difficult, right? You know what you do? You see, we're going to pursue the same policy as you. We're going to make it remarkably hard for you to transfer all of this capital into our country. We don't need it. The only people who need it are the people who are profiting from higher and higher asset prices. But that's to the impoverishment of everyone else. I mean, that's kind of the energy behind Trump. Trump's not the person to deliver it, right? The hope is there's going to be a fool on a fool's journey with his little pack on his shoulder, and he can communicate and he can understand economics, and he can say, folks, you've been sold lies, okay? What we got to do here is we got to put up like taxes on all this transfer of money coming in. We got to make it really impossibly hard for other countries to dump capital into our markets, because they're making what was once a great entrepreneurial society into a speculative society where, look at us. I mean, we should be doing something more constructive, right? And instead we're speculating in the price of bonds and stocks and the gold price. Because
So you think corruption or even just general policy is probably the biggest thing affecting us right now? Then I don't know. That's what I'm kind of picking up on.
I don't like those words. I would say I think it's just the theory of cock up. I think you've got mostly well-meaning public servants, and they just blunder through the system because it's a complicated system. And actually, it's the advisors. They're not getting good advice. And why? Because the advisors are all hooked to Wall Street onto the drip of becoming richer and richer at the expense of everyone else. Wow. The Fed, it's easy to slam the Fed. Problem with look at Jay Powell, right? I mean, I don't agree with his policies. I don't agree with a lot of things he does, but is he corrupt? No.
Yeah, I agree. He's not. I agree 100%. I think he's not. I've heard people tell me it's shady. I say I don't think so. I think he may have not done the best job, but he seems like a pretty genuine, straightforward individual.
Yeah, I mean, why anyone would want the job? That mandate. Now, however, is Jay like one of the leading great lights in economic clarity? Does this guy does he really understand money? Was he hired because of his profound intellect in the understanding of money? The answer is no.
No, yeah, that's what we just even we even realized it, like low key. Jerome Powell's been kind of a career politician. I know he worked at Carlyle. He had a history doing investment stuff. He's a lawyer, but he's been in government since the 90s. I mean, he was even helping Buffett and Solomon Brothers and all of that. So it's a very, very interesting point right there.
I mean, let's turn it on its head. Oh, not on its head, but just to accentuate that. Credit Suisse is no longer in the land of the living. Okay. It effectively failed. Okay. However, if you look at every very, very tight regulatory control and demands placed on that bank, because it was deemed to be a too big to fail institution, it was absolutely scrutinized to the finite detail, and it met absolutely every metric of stability and robustness, and yet it failed. That, and again, I'm paraphrasing Jeff Snyder here, but that just exposes this fallacy that they understand money. They don't.
I agree. I agree 100%. Now, let me ask you this. Let's take it back a little bit, like even looking at society. And I like what you said, where most people are like genuine, well, they mean well. How would you compare like the money developments in the economy and even how people in the trade balances, how would you compare this to Japan and like between like the 70s and the 90s and last time where we started raising, we had low rates and everyone would go, all the hot money goes to Japan. Then they pull out right when we start raising again. Was it similar back then? Would you say the culture is similar or no?
There is an argument that we've had essentially 4 iterations of the same thing, and China being the 4th and most current iteration of the rest of we all want to believe in God. We all are looking for idolatry. We want to worship something, you know, and countries are no different. And so we worshipped Japan and its what was perceived to be its economic model, because year after year after year they just got their stocks went up. They made like funky things. People wanted to buy it. They operated trade surpluses, and people in their head believe that's a good thing. And we started examining their culture. We had all these kind of, we looked at their industrial process, and you had these Japanese names like Kanban, and it was how they were organizing production. And all it was, again, was a form of mercantilism and an out of control expansion in credit within Japan, which exaggerated things. So what I want to say about that, think about GDP. GDP is the total sum of spending in the economy. And of course, if it's the total of spending, then it's the total of all the output of goods produced and services produced in the economy. And we handicap that figure, and we talk about nominal, and then we handicap it with inflation, and we say, well, okay, nominal was 5, but inflation was running at 3, and so real GDP is 2. Okay. Now, I've never understood why we stopped at that point. I think we'd be better served if we handicapped again and we said, well, hold on a second. Actually, over the course of this calendar year, the total debt in the economy rose 10 percentage points versus GDP. You know, and so actually the growth rate that you're seeing in GDP has been inflated by the debt. And don't we kind of want to compare countries pari passu? So we want to take out the idiosyncratic either increase or decrease in national debt to actually get an impression of the underlying expansion in income that year from, you know, the productive allocation of people's time and effort. We don't do that. And so Japan was an example of debt was going up. People had this idolatry. They thought it was low risk, that Japanese people were different, and they wanted to lend to them. And at some point, Japan got too much debt. Asset prices began to fall. And we discovered that the Japanese were just like us. You know, they got some good things right, and they made some really, really dumb decisions. Now, before Japan, it was Brazil. Brazil was like this, like, dope place, had a, you know, like, cool place to go, big country, lots of natural resources. They were investing in infrastructure, and they were growing, you know, but they were no different. And before Brazil, would you believe it was Russia? You know, like, there was a time when the West was absolutely convinced that, you know, the Russian communist system was the way to expand GDP. I mean, China is simply the latest iteration of idolatry, which I would say is misplaced. And if we had that additional calibration of debt to GDP and we took it out of the equation, we handicapped all countries, I think we'd get more clarity, albeit one could say at this point in the universe, in the financial universe, I don't think there is a country where debt to GDP is not expanding. So.
Yeah. And so it seems like credit and debt is like a big thing. Like, I feel like you're not really as convinced about, like, okay, yeah, you make money. Yeah, you have GDP. You're kind of more like, give me the net. Like, where did it really come from? And then the debt. And then, again, tying this back now into the politics. But, like, how did they gain so much debt? Was that because of their politicians not being guided well? Was it because the demand was there? How did they get to that point, essentially?
Well, I mean, money is a belief system. Okay. And so if you get your propaganda on point, right, then you create a cult. And the cult is such that you want to be a participant, and the cost of membership is extending credit, is making loans, and everyone wants to make loans. You know, like, China was probably peak cult in kind of like going through COVID in the sense that what happened, their trade surplus just exploded. We were all on our ass. They seemed to like be able to control. Remember when we thought they could control the pandemic, and they were just booming. And I think the year 2021, the institutional allocation of money, of investment flows into China was at its highest ever, right? And now people just, they just can't wait to get money out. I mean, we just get,
but that's where like it looked like that. And then the politicians came in. I mean, Xi Jinping's crackdown and all of that. So, I mean, if China, let's say, would be that fourth iteration, would the way they have control of everything, would that possibly be the thing that maybe makes it where they don't repeat what everybody has done? I mean, can excessive control protect you from falling into this mercantile trap? Well,
the control that this is good because it's I believe it's reinforcing because it goes back to the de-dollarization. I want to say to you that the Chinese yuan will never replicate the success of the US dollar. It won't be a reserve currency for the very reason that the controls that they apply to the flow of money in and out of China will never make it an acceptable reserve currency. So the Chinese, indeed the world today, I think is horribly disfigured owing to the Asian tiger crisis at the end of the 1990s. Thailand, I think, Thailand's GDP expanded at something close to 20% per annum for 20 years.
It was all of them. It was them, Malaysia, and it started with Japan, and then right when we raised rates, everything just went whoosh right out.
Yeah, so if we look at that period, so that's there was a 20-year period of massive economic expansion out of Southeast Asia. If you go back 20 years from that data point, that takes you into the 70s. In the 1970s, the cognoscenti thought Asia was was laughing stock. It was just like the people were kind of different culturally. They just weren't switched on. We invent, we have fallacies when we create these narratives. In the 1970s, like I say, like the country that they lusted after was Brazil, right? The financial community fell over themselves investing in South America. Right? That's where the growth was. And what happened when Volcker was raising interest rates, South America just blew up. They had too much debt. The money was invested poorly. And therefore, when rates hit a point, South America just went down, collapsed. And people are like, And so then the money switched into Southeast Asia. And then when money starts coming in, because the economies had been starved of capital, there was lots of productive and profitable investments. And so suddenly you got a 20-year cycle, which culminated in like mean extension, the prices being too far away from reality. And so we had that crisis. And that crisis was prompted by international investors pulling the money out, capital flow saying, I've changed my mind. Okay. And the lesson to the Chinese was, oh my God, George Soros, why are people so scared of George Soros? It's like, again, idolatry. And then we need to be scared of some bogeyman. It's all an invention. Invest without prejudice, people. But anyway, the Chinese looked at that and they said, we will never allow unfettered capital access into our country because the only thing that we need to be the Chinese Communist Party forever. And so we can't be vulnerable to the vicissitudes of capital flows. That was the seed origin of markets being where they are today. Like markets in the world have just gone like that because China's not allowed that unfettered access. And the more money tried to come into China via trade flows and speculative flows, China channeled it and pushed it right back into the US and pushed stocks and property prices and everything to the sky. And now we have a generation of people that can't afford anything. You can't afford to, you can't afford a university education. If you get one, you can't afford, an apartment in a major metropolis, et cetera, et cetera.
So we're inheriting it then, essentially.
Yeah.
So let me ask you this though. Then, with all of this now, we've got to even go through a little bit of history in different countries. Now, let's talk about right now. So why haven't we had that happen yet? How come we see banking collapse? I mean, we just even had Evergrande. I know that was Asia, but even now it's like, because the question everyone's asking, I see a lot of people who get frustrated and I tell them to calm down. I'm like, markets take time. Don't underestimate the resiliency. But it's like, how come we have 5 times debt to GDP right now? We have a lot of the similar setup. How come the same shocks that would have, made people leave, how come we're not seeing that now? And I mean, I guess what makes us so special, especially with all of the other problems that we possess?
In terms of the American financial assets, why are American financial assets so special?
Why won't it go down? No matter what happens, how come it never goes down?
Well, it does. Government treasury bond prices were actually the greatest bull market of the last 30 years. And I say greatest. If you measure how much they've gone up versus the price volatility, they've gone up typically without jarring you. It's been a very smooth progression higher and higher, which has meant that you could own more of them. If Bitcoin had a volatility of 50, how much could you, you're bullish, but how much of your wealth could you really park in an asset which was like boom, 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 boom? I mean, it's gone from 67,000 and it hit like 18 something. And maybe it's going to hit 8 something, and then maybe it's going to hit 120,000. I mean, like, your allocation there is going to be kind of small, whereas your treasuries historically have just gone and so your allocation would be very high.
So you think our bond market is what has given us the stability then? Or is that our extra layer of armor?
I'm saying the bond market has been stable, but it's been stable for reasons which are not fantastic. Again, it's been stable because inflation has been falling, and I know this is past tense. I know that we live in a world where prices have become very elevated in the last 2 years, but since 1980, inflation across the world has fallen.
It's non-existent.
But I would attribute that to beggar thy neighbor policies. Like, China and mercantilist nations expand and prosper at the expense of the household sector in the West. Okay, so that's why bond prices, I think, have been so high. But to your point, things never go down. Well, I'm saying to you, you've wiped out like almost 25 years of price appreciation in U.S. treasuries. So they do happen. 2008 did happen. Your Bitcoin has fallen from 67,000 to 18,000. And then if you go into the stock market, if you look at the S&P 500, you will find plenty of well-known household names which are trading at the same nominal price as they traded 20 years ago.
Yeah.
It's there, but it's kind of disguised because you have stocks like Google and Microsoft and the Teslas of this world. And as they get bigger and bigger, they kind of, if you will, distort the picture. And so that remains a clear and present danger. And then where we are just now is you've had like the greatest financial tightening of conditions. And like I've been warning, you're going to break things. So you've got well-meaning public servants who don't understand money. It's a bit like if you've seen the serialization of the drama which led to the nuclear power plant blowing up in Chernobyl. I mean, these guys are sitting, they've got a control panel, and they're like
I like that. That's a great visual to think of. I've never compared the Fed to Chernobyl, but I see it.
Imagine there's a big red button that's called higher interest rates. And the nuclear power station is the fact that, I must correct you, we're not 5 times debt to GDP. If we were to approximate to the nearest whole number, it would be 4 times. But we've got 4 times debt to GDP, which is 4 times greater than it was 40 years ago, right? So it's that's the nuclear energy, and that's what's pushed asset prices up, etc. But if you mess with it, if you press that red button in the Chernobyl power station, this baby's gonna blow. You're gonna blow the whole damn thing up. And I've been like, Jay, please, no, guys, don't do this. Right? And what are we seeing? We've seen people getting worried, like regional banks. Regional banks are really, really important lifeblood of the United States economy, and like no one wants to touch them, right? We've just seen Credit Suisse, one of the most strategically significant banks in the world, and it doesn't exist anymore. And yet, if you were looking at the control panel in Chernobyl, they're like, hey, these are the capital ratios good. If we look at the Basel III things, everything is compliant. But boom, okay, why? There's a famous phrase from the former West German chancellor in the late 1970s. Remember, the Fed went to 20% interest rates. And he said, interest rates are the highest ever since Jesus Christ walked on the earth. I want to say to you, interest rates are higher now. They're higher because whilst they're 5 and not 20, if you multiply the 5 by 4, which is the debt to GDP, we're at the level with this. I mean, I'm in the power station and I'm getting sweaty. The steam coming out, the thing's vibrating. Boom.
But then, so will that be the instance then where we actually see things come down then, where it's not like pretty much can Google hide from that or no? Is that where you see that next level?
That's the next level. So, again, what happens? Remember, we've mentioned this awful pandemic, and we don't have a lot of data points. We knew that there was a devastating pandemic after the Second World War, and it killed, 1 or 2% of the global population. It was terrifying. And so there was a moment where you're thinking, GDP could just collapse, 10, 20%. And of course it didn't, but suddenly amidst all this great fear, there were companies and their profits went up. Netflix and Google and and Apple, of course. And people are like, holy shit. These businesses are riskless, right? We've just had this alien body snatching invasion. We're all doomed. and profits are going higher and higher. Like people are buying more and more iPhones and they're on Zoom and they're watching more Netflix. And literally, when you convince yourself that something is riskless, there is no upper limit to the price that you are willing to pay for it. It becomes like a Modigliani, a Picasso. It becomes a piece of art. Like people just pay anything. That's where we were.
Do you think that could maintain this time around then? Will we see that if credit gets messed up? Will people still be paying? Because we still haven't seen people cancel Netflix, even when the stock dropped too. It's like, will that happen again?
I mean, but they did. Their ardor, the momentum in the flow.
Yeah, it's not like 2015. They're not. Not the same.
Netflix are looking at different remuneration models. They were thinking about like putting advertising through the thing. Domestic US growth has moderated. International is not as strong, Yeah. But I want to say, let's be provocative. Why not? I think the Fed raising the cost of debt in a world which is drowning in debt is actually scarier than a pandemic. I think has the ability to really hold the economy more than the pandemic. And time will tell. I mean, the problem is not knowing what's going to happen, not knowing the destination, the outcome. The problem is surviving until enough people have worked it out. I knew in early 2007. Well, I didn't know that Lehman's was going to go bankrupt. I didn't know particular names, but I knew that the system was acutely vulnerable and could just go like Chernobyl, boom. Okay. And there was, it was like just cranky, weird people. You've seen the movie, The Big Short. I mean, they made a movie out of it because the people were kind of funky. They were kind of like, they're not suits. Let's say there's like 50 or 150 people in the world that knew about it. So the world's going to blow up. And Elon's got a rocket going to Mars. And I'm like, I got to get on that rocket. And then let's go into Charlie and the Chocolate. Let's just throw every metaphor at this thing. If you read Charlie and the Chocolate Bar, you got the poor kid, Charlie. But if you're one of the lucky ones and you buy the chocolate bar and it's got the gold wrap and you've got the invitation, then you get to go on Musk's rocket and you get to be one of the ones that survive the catastrophe, right? And I had that damn ticket. And then what happened was I had a custodian bank, so I had the trade, in the mortgage securities I was short. I was buying protection, etc. And then the overseeing custodian bank said, "You got to sell." I'm like, "What?" Like, it's like I'm walking onto the spaceship, and they're like, "No, I'm sorry, your ticket's no good." I'm like,
"Wait, why? Why'd they tell you have to sell?"
Because they were damn stupid. The saner answer is that the securities that I was buying were a new invention. They hadn't been around. And the custodian's responsibility was to verify my net asset value and therefore to make a market in my hedge fund. And their point was, and I bought a lot. I mean, I really bought a lot of Charlie's chocolate.
Charlie chocolate.
I bought a lot of Charlie's chocolate. And they're like, no, we can't make a market. So I was like, merd. And I had to then buy more chocolate. I had to conceive of another way of doing it. But anyway, so I did get safe passage, but they kept me in the airport, if you will, in the terminal until the thing was just about to go. I mean, so I had 15 months of hell, of knowing what was going to happen, but no one else knew. And they were, oil went to $150 because the future was so bright. The ECB raised interest rates, A, because they're idiots, B, because they thought the future was so bright. And every time the Federal Reserve was cutting interest rates from September 2007, every time the Fed cut interest rates, the back end of the bond market was raising future expectations because, like, the future's so bright. And I'm like, why is everyone crazy? And then, of course, right at the very last minute, that in October, it just blew up. I made 50% and gained some notoriety or whatever.
Honestly, that's what I'm surprised that you do not get as much notoriety as like Michael Burry, because you went through the same thing. You were, and even then, to the point now, I've been telling people now, like, yeah, you got to make it till the end. So, like, would you say surviving up until the moment is harder than actually reacting in the moment?
I would say to you that surviving is actually a harder operation than actually conceiving the destination. It's kind of easy to conceive of what's going to happen. Again, if you can kind of get your mind to be loose and to kind of try and see around corners, it's feasible. One of my favorite books, which we spoke about how fiction can be the key that allows the successful processing of the mental traffic. And there's a book by John Buchanan, a Scottish writer, and it's just a little short story, and it's about nothing, but it has a German professor who believes that he can train the mind to see the future, and there's a dinner party, and he takes three hosts, three invités at the party, and one of them's a banker, and he trains his mind to read the front page of the Wall Street Journal in 1 year's time. And so he's seen the future, and the stories and the book is all about forewarned with what's going to happen, what actually happens. And that's that's when markets get funky.
I like it. I want to read that.
Yeah. Or read the Bible.
I do. Dude, that's a big thing. I say Proverbs. I say Proverbs is the best business book ever written. A lot of people don't realize it. 100%.
It's the best guide to investing. Jesus, he's the Almighty, and he knows that over the weekend he's going to be crucified. I mean, he's like, why do you need to crucify me? But he's like, oh, bugger, and he says to his disciples, he's like, guys,
he hands them the bread, and they're like, he ain't gonna die. Nah, he ain't.
He looks at Peter and Paul, the guys who wrote these great books, and he says, guys, you're going to reject me. No, reject you? You God. I can't reject God. He's like, look, it's going to happen. I've seen it. Like, impossible. And of course, we know that when the guards come to get him, I think he's in the bushes doing a wee or something, and so the guards don't see him, and they're like, we're here for Jesus, the guy with the hair, those kind of funky boots, he does miracles, and they're like, you've never heard of him, cock crows one time, cock crows two times, cock crows three times, and they keep rejecting. They've seen the future and they reject it. How
dude,
many
my mind is blown. I've read a lot of the Bible, but connecting that to the whole concept of you could know what happens and then how. Oh my gosh, that's amazing. That's amazing. So let me ask you this now. This time around, yeah, I feel like you know what's going on with everything. I feel like you have ideas. Are you going to jump on it the same way you did last time, or what's your approach to it this time around? Now, like you know a little bit. So I'm sure people would even disagree and think everything's all rosy. So what would be your take? I mean, is this something where you jump on it? If you see a big mean reversion, do you jump on it right away, or how do you play it? You have the experience from 2008.
Yeah. Well, first and foremost, yeah, I'm no longer engaged in managing other people's money. First. Yeah.
So just you personally, you just handle your own personal money.
And then my personal money, I don't really have any. I mean, I'm sofa surfing at friends' houses around the world. Why don't
you're welcome? You're welcome to come anytime, man. San Diego and LA, I got you, bro. Anytime.
Oh, I'm coming. I like San Diego. Is San Diego?
Oh, dude,
is that where Coronado Island is?
Yeah. Oh, dude, there's a lot. San Diego's nice now. Like it used to be where everybody liked LA more, and now San Diego they're like it's LA without all of the smog and crime. So, please, anytime, man.
I mean, you're just making me think of more of these spiritual books. I mean, the thing I've gained an understanding the last 12 months is the importance of impermanence. We persuade ourselves that everything is permanent, everything's going to last. And again, think of what I said to you, the UK rejected the gold standard. Like the gold standard it was thought to be permanent. And again, back to this de-dollarization. It's very hard to conceive of a world that doesn't have this global dominance of the dollar, perception of it. But, nothing is permanent. Things will change. And therefore, the question to people watching this is, how prepared are you for change? But to answer your original question, I think what I'm doing is my risk capital today is my reputation. And I'm out there, I'm on this show, and, I write sporadically on Twitter. I can't write formulaically. I'm not there kind of trying to play with an algo and trying to get numbers.
Yeah.
When things pass in here, I share with people. And I've said, I think this market's easy. I belong TLT and I went on stocks.
Amen.
So,
Amen.
If I'm wrong, you can pee on my reputation,
Well, let me ask you this. What do you think about the yen? So let's say things go bust again. Well, do you think the yen will return to safe haven status? Because it was already wild that it even weakened how it did this last year and a half. But do you think people, if the dollar got messed up or anything, again, even if our banks had problems, do you think people would return back to the yen again? Or is that permanence of yen safe haven over now forever?
Okay. So, we have deflationary money. You said something about, if the banks kind of get a bit funky again, we have deflationary money. The banking system is a tail that's really going to slap us all around, I think, in a manner that we saw similar to 2008. The question on the yen is a great question. The yen has been formidably strong, and when bad things have happened globally, the yen has typically strengthened. And there's a lot of perception as to why that is. And then we come in with the impermanence of everything. So nothing is guaranteed to last forever. And we've had a big challenge to the price charts to say, the market's kind of saying the yen could weaken and it could lose its status. The status is presently being questioned. And of course, I think there's a lot of silly talk about their vulnerability because they've been doing QE for almost 30 years.
Forever.
But the charts do say something. The charts have a perception of change within them. The very, very long term. Again, what was I saying? 20 and 50 month charts, if not 200-month charts and stuff. They're all kind of, markets are kind of going, I've kind of tried to rationalize that. So I said QE. I believe QE is camouflage it's a fluster buster. It sounds good. And when no one really understands money, you can kind of say, I'm printing money, I'm doing QE. And I think that's nonsense. I keep trying to buy coffees I don't really go to Starbucks, but in their kind of funkier equivalent, but they don't accept bank reserves. They kick me out. I've got to use my Apple iPhone. Japan, however, has had, maybe because it's had it longer, but what's been happening is that there's a suspicion that these huge Japanese banks have been going into what we call the euro-dollar market. Euro-dollar market is simply a market which exists outside the sovereignty of the United States, and where if you can provide adequate collateral, then another bank will print dollars, will create dollars. I think there's more dollars created. I know there's more dollars created outside the sovereignty of the United States rather than inside via domestic institutions extending credit to US citizens. And what's happened in Japan is, again, we talked about idolatry, and the Japanese, like everyone else, came to believe that China just was dope, that whatever those communists are doing, just like we thought with the Russians in the 40s, the 50s, the 60s, and the 70s, just like we thought of Brazil in the 70s, like this thing's going to last forever. I got to get skin in the game. And there is a suspicion that the Japanese wholesale banks were able to go to the lending window, if you will. If we think of this little window where you go into, hey, hi, and you're like, hey, if I give you this, will you give me dollars? And they're like, what you got? And they're like, well, we've got all these bank reserves. What if I gave you like $1 billion of Japanese bank reserves
that we print every day?
And they're like, yeah, I'll give you, $500 billion. And you're like, wow, okay. But I'm only going to give you it overnight. So you've got to go back each day, if you will. But they take those dollars, and then they've gone into the Chinese financial markets. And again, despite all the nonsense you hear, China has a huge, immense need for US dollars. Dollars are scarce within the global banking system. It's why the dollar has risen by and large against everything else in the last 15 years. And so the Japanese are taking this kind of bank reserves, they're getting dollars, and then they're taking credit and term risk to Chinese borrowers. And that's something that I actually believe that is what we saw in the initial kind of where the yen suddenly just dropped and became very weak. I think it's more that than JGBs and the Bank of Japan's accumulation of JGBs, the great widowmaker trade. I actually think it's that. Now, that is still supposition. It has not been demonstrated or confirmed by a very important indicator. And that indicator would be the CDS price, the cost of protecting the senior bonds of Japanese banks. The price of protection is it's a little bit high, but it's historically is blah. That's something I watch very closely. That would why would that be important? Because if I've lent these goons my dollars and I've accepted their kind of collateral of bank reserves, and then I realize they've lent it to Chinese property companies and they've given them like 10 years to a lot of term risk, I start to get really worried I'm not going to get my capital return. So
so you'll hedge it.
Yeah, and so I'm hedging, so I'm buying protection against the viability of those institutions. Like I said, that message just now is split, but I'm conscious of the time. I in terms of my funky mind, I'm reputationally very long the price performance of I'm reputationally very long the price performance of US Treasury ultra long bonds in an environment where everyone is screaming inflation. Yeah, okay. And so I think the price is, if my reputation escapes damage, and if I'm validated, the price of those bonds will go shooting up, which is to say we will see a pretty severe and shocking economic global recession. I think the portents of that are everywhere. But And what I'm saying to you is, if we had 2008, we had 2009, and the instigation of quantitative easing and the funny money and asset prices recovering, I can conceive of a world. Where really bad things happen, which creates a further revolution in central banks, where like Jay will be kicked out, they'll get another person, and he'll have even crazier ideas. And so my thing is absurdity. I think the treasury bond market the bull market will one day end, and that day is within 2 or 3 years. And I think the corollary of that is to finally answer your question, the permanence of this very safe, very strong yen. I think that will wither. I think that will die. And I think the catalyst for both of those things is that we will have a severe and shocking recession, or whatever term you apply to, like that 2008 period. And the aftermath, or how they deal with that, will ultimately create a real devaluation in fiat and financial assets.
So I don't know. Correct me if I'm wrong. So you think then U.S. bonds would be a better safe haven than the yen currently?
And I think actually that they will perform. I think they're the same side of one coin.
Yeah. Okay.
You know, they're heads to the tails of equities, let's say.
Yeah. All right, I could agree with that. And now let me ask you this, because I know we've heard TLT a lot. And actually, I don't know if you know, so that's one thing that got us pretty big here on with the Colt. In 2020, I made a video telling everybody to buy TLT right before Powell, right before he did that. So we were actually like, we bought all the TLT options. It was like 30,000%. It was everybody on YouTube made a lot, and we love TLT. But let me ask you this. Why TLT? Why 20-year plus versus like IEF or 10-year bonds? So what do you think about the 10-year versus 20?
It's just bigger bang for your buck. I mean, I'm talking to the people listening to you. You know, I'm not talking to in the main. I'm not talking to. If I was a hedge fund, I'd have an ISDA agreement, which is essentially it's like having a drug dealer on fast dial, right? And like, I need shit, boom, it happens, right? That's an ISDA agreement. It's a license to thrill. It's a credit agreement where you just get unlimited leverage. And so I could buy cash, the Fed's at 5, and I think they might be at 0. Right? Okay, so why don't, like, you were asking me about 10-year, why don't I own like 2-year? Yeah. And if I was a hedge fund, and indeed that's what I was doing in 2008, I was actually believing that the 2-year rate would fall more sharply than the 10-year, because there's term risk, there's there's a lot of things that can happen beyond 2 years. But you need an ISDA agreement. You need a counterparty that's giving you a ton of leverage. In the real world where we are, I mean, I'm in Malibu, so I'm not in the real world. Mostly in my head, which is not the real world. But, the metaphor of the real world. You don't have your bank giving you like $1 million of notional leverage. Okay, so let's say you've got $100,000, and so you're a Delta One investor. Well, if you're right, the ultra long, the price performance will be leveraged. It will give you more bang for your buck than the 10-year, and it'll give you more bang for your buck than the 2-year. Okay, so it's a duration. We would say it's a duration adjusted thing. So you want lots of duration, you want lots of bang for your buck, because you're limited by a lack of leverage.
All right, I love it. Thank you, Chad. I hope you guys hear that when you're watching this. I hope they make it this far for that. That's beautiful. So now I guess maybe I don't know how much time you have left here, even here too. But I could give you one more good question.
Sure,
we can keep going. We could do this forever too. I've been loving it so far. I really appreciate it.
Well, we can do it again.
What do you think?
Let's do one more.
Yeah, let's we'll wrap it up with this easy one, but not so easy. Do you think the regional banking crisis and what we're getting now, do you think it's over, and or do you think it'll spread beyond what we've already seen?
It's only just beginning, the regional banks. I mean, every banker now is terrified. It's absolutely terrified. I'm sitting here. It's as if I'm sitting here. I'm like, yeah. And then boom, I just been punched in the face. And I'm like, what did I do wrong? It's not obvious. Like I said to you, if we look at Credit Suisse, there was nothing wrong in its regulated capital. All the things they insist on, everything was impeccable, and it died. So Silicon Valley, were they naive and like incompetent managers? I think we can overdo that. That's like when you get angry and you start calling names. Again, you're investing with prejudice. They were acutely vulnerable to a particular part of the economy, which was, startups, tech startups. And we discovered they just got a lot of money, but they didn't actually have a lot of, certainly in the short term, profitable investments to make. And so once they had spent the money, they just needed more money. And we stopped that because, the Fed was pursuing deflationary money. So the bank boomed. But, we discovered that your bank deposits just disappear. Remember, a bank is a weird construct because it has short-term liabilities. Your deposit, you just, we thought you would kind of go to the bank, you would write out an instruction form, and then you say, I want to take my money. Right now we realize you just get your phone, you go boom. Okay. So you have these liabilities which can be processed and transacted against you instantaneously, and against that you don't have liquidity in the asset base. The asset base is loans, right? So if you get a run, you kind of got to go, you got to call in loans. It's complicated stuff. So you have loans to real businesses, or you lend to the government, and you do that via investing in fixed income securities. You try and hedge, but your interest rate risk, again, remember there's a big, Silicon Valley were idiots because their hedging was either non-existent or just poor. Again, the counter to that is Credit Suisse, in its statement of the week preceding its bankruptcy, said, we are fully hedged on interest rates. Okay, so albeit, does that mean they were fully hedged on interest rates going up? Does it apply to interest rates going down? Because we don't know the answer to that. But they had professional and they had substantial interest rate protection on their book. They still went boom. So banks, no one wants to be the next guy. And they've got this precarious business of liabilities that can disappear immediately, and assets which are really kind of hard to turn into cash. And they're caught in the middle. When that equation goes wrong, your equity goes to zero and your debt. So the risk appetite for the banking sector, their willingness to, you chap on the window and like, hey, hi, I'm the asset capitalist. Can I borrow $1 million? I'm like, get out of here. Like, come back in a year's time when we figured this out. So, the Fed's got the highest interest rates since Jesus Christ. The banks have got no interest in extending credit. We kind of spent 2 years over-ordering stuff with Amazon and Walmart and stuff, and now we're just trying to get rid of things. Even the biggest companies are laying off, Microsoft, Google, and all that stuff. They're laying off like 10, 15% of their workforce. And supposedly, this is like the strongest economy ever. So, metaphorically, I feel like I can see dead people everywhere I look.
So you think so, but I guess would the timing of it be there? Because now, like you said, nobody wants to be what's next. Do you think, it sounds like you think credit contraction will arise, they're not going to want to loan money, but then I guess this fear of being next, do you think it will stop them?
It will stop the Fed. Oh, stop who? What do you mean? Say again.
Well, either stop the Fed, or do you think it will get these banks to really double down on making sure that they prevent any of this stuff from happening?
Yeah, it's the latter. They're doubling down. They're taking strenuous efforts to protect themselves. And there's a kind of fallacy of composition that the stronger each bank seeks to make its own fiefdom, collectively, they make the system weaker. The stronger you are, which is a function of you're not extending credit, And then all of your competitors, they do the same. And so you're pulling credit out of the system, which is like me trying to speak without oxygen, which might be a good idea, might stop me speaking. But eventually I'm going to expire. I'm going to fall over because the system needs credit. So we've now got precedent, and we've incentivized banks to kind of rein in credit provision. And without credit provision, the economy withers very rapidly. You know, we go into recession. So fallacy of composition is always a major, important and overlooked danger. That's where we are.
Wow, I love it. I never thought about that. Make it so this, as they try to get stronger, they weaken everything collectively. I love it. I love it.